What are the biggest changes to the investment landscape that will be taking place into 2025 following the presidential election? And what are the best ways to grow and protect your wealth? We're talking about financial and wealth planning and management with our next guest, Douglas Boneparth. He is the president at Bone Fide Wealth. Douglas, welcome to the show. Good to host you today.
Thanks for having me.
It's been a great year for investors. If you just put your money in the index, close your eyes, you would have been up. Is that going to continue, you think, next year?
We'll see. I mean, as long as the Federal Reserve is continuing to print, I think we probably can see equities continuing their expansion here. But all kidding aside, we're in a really sweet spot when we think about the economy with some of the headline prints that we have here. So it certainly has the capability to continue going. All-time highs beget new all-time highs. So there likely could be a really good case to have a strong start to the year. Although there are certainly some big X factors and headwinds out there along the lines of geopolitical risk and this little thing called the general election here in the U.S. Not quite sure which way the wind's going to blow, but we're going to find out pretty soon.
Well, what's your base case scenario for economic growth? Are we going to get a soft landing, hard landing next year, and then earnings? How would that be impacted by growth?
Yeah, so I mean, I think this really comes down to whether or not we can continue to have strong prints in economic news. The one thing, if the inflation story is a 2023 story, and you believe that we've kind of dealt with that, then we turn our attention to jobs, which obviously seem to be softening a little bit, but GDP just the other day, or today, 2.8%, not bad. Again, we're getting these prints that suggest it's a sweet spot. So right now, the base case is soft to no landing, if you can believe it, after everyone was screaming something between hard landing and soft landing. And if you go back not too long ago, it was all but assured we would have a recession in 2023. Not only did that not happen coming out of a dismal year in 22, but look what happened here in 2024. That rally continued, and again, we're getting reports that look pretty good as far as being in the sweet spot economically.
GDP at 2.8% last quarter. Advanced retail sales came in last month rather, a little bit harder than expected. Are these trends pointing to higher inflation down the line, you think?
That would really, I think, spook the markets and catch the Federal Reserve on its heels. I think that's a disaster situation for them for the most part, is to see inflation come back after cutting rates 50%. But maybe there's some explanation here as to why the 10-year back up at 4.3. How do we see rising rates on the 10-year, yet we cut them 50 basis points? That's probably a signal that things aren't deteriorating as quickly as maybe the Fed had anticipated. So moving forward, what are we going to see out of them as far as final cuts for this year and into the first quarter? That might be a signal, hey, let's maybe be cautious here or not cut as heavily. But I would also argue there's not a lot of room to the upside, when we're thinking about that 10-year or the longer term yields, probably more to the downside here. So, a little all over the place, but kind of back to jobs. That's what I'd be focusing on. If there's really going to be some kind of calamity in the broader economy, I would be pointing to, hey, are we seeing material weakness and softness in jobs? Because everything else seems to be moving along at a pretty decent clip here. Also, throw this in there as well. We're in the midst of earnings season. Certainly the Mag 7, just yesterday we got Google reporting. We have Apple and Amazon coming up as well. Some strong earnings from, the largest components of the S&P could set the tone for how we finish this year and kick things off into 2025. So I'd keep my eyes on that as well.
This year was a flight to quality. The biggest high quality names within the S&P and NASDAQ saw growth, while the rest of this Russell 2000 more or less stagnated, until we got to the last quarter, and then things started to pick up again. But Douglas, flight to quality, will that continue into next year, or is that going to be a return to 2021 when everything went up at the same time?
Yeah, I think what would be a great indicator of the health of the market would to see that overall lift over the summer, right? We had really a quite an impressive rally out of small mid cap stocks, something that was really being cheered here and kind of, led into this year end momentum before that fizzled out a little bit. And the attention went right back to, your mega caps here. So if I had a wish list for 2025, on the bullish side, and I'm usually a bull, it would be to see again those mid and small caps also participating in the lift on the market as the steam run down here for those large and mega cap stocks. Interestingly enough, if we do take the assumption that rates will continue to come down, right, and you know, pressure on bonds starts to become that to yields going down and their prices going up, is there an opportunity as well? This is a rare moment where equities remain strong, and also there's an opportunity for appreciation in the bond market. I thought we were losing that trade as the 10-year came down after before rate cuts, and now here we are noticing that we're right back to where we were July highs. So is that a signal for, hey, we can go long duration here in our fixed income for this? So older, more conservative investors might have that opportunity on their hands. But, if you talk to Drunken Miller, he'll tell you he's shorting bonds right now. And it just goes to show that everyone has an opinion out here. So, all in all, again, the headline's looking pretty good, but you got plenty of uncertainties out there. And your crystal ball is as good as mine.
My crystal ball is pretty waxy, so I don't think you want to compare it to mine. It's just been muddy. That's why I'm in the interviewing business and not in the giving answers business. But anyway, your job is a lot harder than mine. Take a look at my screen, 10-year yield. Let's talk about the bond market for a minute. You mentioned that you don't think there's too much upside left for this run up on the yields. Well, first of all, what happened since the beginning of September? Why do we go from 3.6 all the way to 4.3?
Any would believe that simply things are better than originally thought here. And it's interesting that we found ourselves trending down in anticipation of that rate cut, only to find ourselves running it up once again. This is something I think most analysts are keeping their eye on here. I'm trying to create a case for how inflation once again gets out of hand and pushes this higher. But in a rate cutting environment where the Fed has all but signaled we're going to continue to cut rates, it's kind of hard for me to imagine this going too much further north. But we'll see. I'm not. I don't think there's a lot of good things waiting for you if the 10-year pushes higher above 4.5 or 4.6.
Some of it was tracking inflation expectations, which recently spiked as well. But take a look at the S&P 500 overlay with yields. This past year saw yields and the S&P rise together in the first half of the year before a divergence happened second half, which I guess is normal for bull markets. But we had in 2022 a year when both stocks and bonds fell, right? Yields went up, stocks went up. Our stocks went down, so bonds and stocks fell together. That was a bad year for the 60-40
year
portfolio.
For fixed income. Worst year for fixed income in a century. Pretty brutal for your conservative,
That's right.
Bond investors. We still are well off those all-time highs in the bond market.
Well, what do you think is going to happen going forward? Do you think this correlation with yields and stocks is going to continue to match here? In other words, 60-40 portfolio, does it still make sense?
60-40 portfolio still to this day is undefeated despite that 2022 year in there and pretty much a flat year in fixed income. You got a lot of performance out of those equities, and if you've been holding those bonds for quite some time, you're not totally disappointed there. And that's more a focus on risk tolerance and how much volatility you want to have in your portfolio. I primarily work with an older millennial demographic where the fixed income exposure is quite limited. Call it your 80-20 portfolio in that case. But listen, we were rarely are we tactical trading in and out of positions, but we took the Fed at their word. That they were going to raise rates, several years ago, and went short duration. And the tough part about getting it right once is you got to get it right twice. You got to know when to go long. And we made that decision a little while back in the year in anticipation of, again, rates coming down and bond prices going up.
Yeah, I'm curious to learn a bit more about Bone Fide Wealth. So tell us a bit more about the clients, the type of clientele that come to your services. What types of investors are they? What do they look for in a financial advisor?
Sure. So the firm was pretty much started and founded about 8 years ago to work with my generation, in this case, an older millennial. I'll turn 40 tomorrow. So you're no longer dealing with the demographic that's sitting in their parents' basement collecting participation trophies. I mean, we're 40, knocking 40 or greater. We have a couple kids or more. A lot of us have managed to buy homes despite how difficult that's been. And we're entering into our peak earning years here. So I've been helping my clients pretty much navigate what it's like to come into adulthood and come into peak earning years into their careers. I would like to say that, the best is yet to come. And as far as asset accumulation, that's ahead of us. But I'd also tell you this, I think there's no more dynamic time in one's life than going from your late 20s into your late 40s. Nothing comes close as far as the amount of stuff that takes place. And we're financial planners at heart. So helping clients obviously navigate this time in their lives, which is rivaled by maybe, retirement as a very far second as far when things kind of change up here. It really shows the power of financial planning. We also do investment management as well to help clients become disciplined and consistent long-term investors. We know that those who can stick to their plan over the longest period of time and participate in the market are the ones that get rewarded the most. So pairing these two things together is how we like to believe people should be working with financial professionals.
Has there been a particular sector or an asset class that has emerged as more popular or more interesting to your group of clients in the past year or so?
Absolutely. I think, for digital natives that are millennials and growing up with computers, we've always been kind of gravitating towards the technology side of things. Like, we're growth investors more than we're value investors. I mean, who in my generation is investing in Harley Davidson? Some of your as more of a joke, but also you think of, the bellwethers that used to be IBM and Coca-Cola, not making any specific claim about either company, but you got companies like Nvidia, Tesla, Microsoft, Apple, whether they're newcomers or companies like Amazon that we've known throughout our childhood. These stories have been magnificent, thus Magnificent Seven, no pun intended, but we get this stuff. It's been part of our lives. It's easy to wrap our head around this. So definitely more of a growth story. There also is an angle to digital assets. I'm seeing a lot more of that. If you asked me 5 years ago, how many times something like Bitcoin would come up in a conversation or digital assets would come up in a convo, I tell you the vast minority of the time. And now it's becoming pretty much something that pops up quite frequently. So maybe, one in every four clients want to know more about it, have a conversation about it, and some are even asking to invest in that space.
Well, how comfortable is this older group of millennials with the idea of adding Bitcoin to their portfolios? Are they accepting of this idea? Are they still skeptical? Are they still on the sidelines? Are they just kind of waiting for more mass adoption? What's the attitude right now?
Yeah, I think there's a lot of curiosity. I think a lot of people have come into the practice with exposure already. I think we're a, inquisitive bunch that have always managed to experiment with things. So I'm not surprised when someone comes into the firm or client says, "Hey, I, put some Bitcoin or Ethereum into a digital wallet, or I was playing around with a digital wallet, wanted to know more about what that is." So I think there's a difference between that and just, "Hey, I demand an allocation to this new asset class." I still think as an advisor who has to deal with various regulatory bodies and compliance considerations, it's not as easy as just going out there and saying, "Hey, I have a high conviction around this. Let's allocate to it." There are some hoops still to jump through here, but it's certainly exciting to see the birth of an asset class throughout my 20-year career. I can't really recall the birth of an entire new asset class. So you got to admit, it's pretty exciting, especially these days as we're knocking on all-time highs with Bitcoin.
What's going to happen over the next 2 decades, as you're aware, is the greatest wealth transfer in pretty much American history, or pretty much all of human history, if you think about it. The boomer generation, as they retire, they're going to pass their wealth on to their kids, people your age, people perhaps even my age and younger. Now, what is going to happen to a couple of things? One, the consumption pattern of the millennials and Gen Ys who will inherit this wealth. And number two, their wealth management priorities going into the next couple of decades as they receive this wealth.
Yeah, this is kind of an interesting thing that is going to take place as it pertains to the practice that I've created here. I never, went into serving my generation with the idea or the primary idea that we would inherit wealth. I usually assume we get nothing, and if it happens, it happens. That's what a good financial planner would do. But it's very hard to ignore the, generation and cohort that has amassed the most amount of wealth, and the fact that we're their children. I'm seeing a lot more in life gifting. Folks are coming to the conclusion that why should they wait to die to help out their kids or their grandkids? That's a very positive thing. If that's happening to you, go hug your parents or grandparents. But yeah, there's going to be a massive transfer of that kind of wealth. How will that affect consumption? I think, millennials are going to obviously have an uptick in how they spend their money. I also think it unlocks the door for an asset class that has been, for a lot of people in my generation, hard to acquire, which is real estate and personal residences. There was that sweet spot where, obviously interest rates were super low during the ZIRP environment, but it has become increasingly more difficult from COVID through today to get your hands on a first time residence here.
I wonder if there's a particular sector that will see more consumption going forward as people, your age and my age become older, start families, their consumption patterns will change. What will they buy more of? What will they buy less of?
Well, assuming they now have the capital to evolve their lives and take the joys of parenthood and home ownership. I mean, real estate again, one of the largest contributors to GDP out there. So the more preservation of owning that real estate or buying real estate, the more money that's going to be put into pretty much anything having to do with that. So go take a look at Home Depot, if you will. Starting families, a whole other box to look into, from education. And if there's anything I could also say, it's cost of childcare. So if we do see an uptick in families being started, a lot of money being poured into that, it's kind of one of the more difficult challenges I think a lot of our clients face when it comes to navigating their financial lives, is the cost of care.
There was reported by I'll just read you the stat. Okay. So this is a pretty scary stat on home affordability. According to the National Association of Home Builders, over 70% of American households surveyed cannot afford a medium priced new house at $495,000. More than half can't even afford a house priced at $250,000. This is nationwide. And of course, there are jurisdictions where the average home price is much higher than the median average of the national average. Okay, so what can be done about this to make housing more affordable?
More homes. Like, I think we have a supply issue here. It's one of the main constraints in terms of keeping prices high in this current environment. Very interesting to see what happened with home valuations during the pandemic and a low interest rate environment. You would think raising interest rates to the extent that the Fed did would have some kind of impact on valuations and home prices. It did not. Maybe you saw some of the more radical conditions of buying a home fade away, like no appraisal or inspection, which we saw during 2020 and 2021 as people were fleeing cities. But now we're just left with high home prices and much higher interest rates. So that hasn't really catered to anyone looking to buy a home. Outside of Maine, metropolitan areas are very desirable areas. Your Floridas, your New Yorks, your Californias, extremely difficult, to go compete in these environments. It's kind of obnoxious to say, well, just, go move to a rural part of Texas or the Midwest where you can buy a large home for a much larger value. Sure. I guess you can make sacrifices in your life to do that, but no one's really, going to just pick up everything and go for the purpose of buying a home. So it's a really, really tough environment here. The best advice I can give anyone, if you have the ability, to increase your income and out earn, basically, again, kind of obnoxious to be like, just go make more money. But if you have the ability to level up your career and your earning power and get ahead of what it is you need to not just put that down payment down, but also actually afford carrying the cost of a home, and that might be one avenue to approach there. What can you do in your career to make more money?
So let's say I'm a potential client of Bone Fide. Okay, I've got a small business. I
Yep.
want to just diversify my wealth, so not all my wealth is in one business, aka mine. Okay, I don't want to. I'm not in a get rich quick scheme. I just want to preserve my wealth, grow it, beat inflation, maybe beat the markets if I'm lucky. What should I do? What should I be looking at?
To diversify away from your business here? I
That's
think it
right.
really,
Yeah.
yeah, I think it depends on what stage of the business you're in. If it's early innings and the early
Hmm.
years, you're all in. Whether you're
Hmm.
bootstrapping or raising
That's
capital
right.
from family. There really is no alternative except your time and every bead of sweat coming out of your face going into your business. But let's say you get to the next phase where there's actually a pipeline of growth and new business development coming in, and you have that. First thing I tell anyone is make sure your margin of safety is rather high, right? Especially for business owners and those that are in volatile markets. So we're talking cash. I love the idea of having a robust cash reserve before we'd even consider diversifying to other risk on assets. Then we can look at tax advantage strategies. We get into the retirement accounts. If you're a small business owner, you get a lot of flexibility here, whether that's setting up your own retirement plan or going into the upper, echelons of tax deferral ability through cash balance plans and a whole bunch of strategies that can be set up there. So capital markets, always a great lever before you start getting into alternative asset classes, which range from real estate just about to anything on a private issue side.
If a client asks you what to do about passive income, okay, what do you think about that area? Do we get real estate and
Yeah.
collect rental income? Should we get bonds? Should we get dividend stocks? What are your thoughts there?
Yeah, this is a preference item. You hear all the time, especially out of younger investors. I want to venture into real estate, and real estate's a wonderful asset class for many different reasons, from tax strategy, appreciation considerations, and all that kind of stuff. But the one thing I always want to tell someone who's dying to get into real estate, who's never done it before, is to be very realistic with themselves. They haven't been on that horse before, so what's it like to be a landlord? Deal with not just the process of acquiring property, but owning property, dealing with tenants. What if it's not local? You want to use a management company. If you're thinking about doing this from that's act. By the way, everyone who says I want real estate so I can enjoy the passive income, yeah, you start out by being an active manager of real estate. It's never just a path directly to passive unless you're buying a securitized form of it or you're the limited partner off of someone else's work in acquiring those properties and dealing with it. So sure, you can be a passive investor from the bat, but if you're like, I want to buy my first rental property, now that's going to be active for a while. But figure out if you like this, because if you're then going to get into multiple properties or short-term rentals, again, active. You got to figure out if you like this. What's it like to get a call at 2 a.m. because a furnace exploded in one of your properties?
So that sounds like a lot of hassle. I don't want to deal with that. What about a REIT? Should I just get into that?
Yeah, if you like real estate or a particular,
Okay.
function of real estate, whether that's industrials, retail, residential, there's plenty of options out there. Be mindful of fees and costs and illiquidity, of course, especially on the non-traded REIT side of things. But there's plenty of opportunities to be a real estate investor by being fully passive in a product like a REIT.
So let's say I'm concerned about inflation for whatever reason. I think inflation might shoot back up to 9.1%, which was the peak that we had year and a half ago. What should I do?
Yeah, if you're anticipating inflation, you typically look to hard assets as that classic hedge, right? These are your precious metals. You got any Bitcoin maxi out there going, well, you got to look over at the digital currencies. It's the hardest of hard assets, and there's a claim to be made over there. So you're looking at that as a way to fight against inflation. Again, real estate showing up into the picture here as another one. But you don't have to go too far out of conventional wisdom and asset allocation to take your pick of assets that are going to do an effective job against inflation. Equity is also not a bad place to think about parking money in an inflationary environment. I'm too young to know what it was like in the late 70s and early 80s, but it wasn't bad time in the fixed income markets, but equities still were probably the only way to really solve at that moment.
Well, what is the role of Bitcoin? So suppose somebody comes to you and says, "Well, I'm curious about Bitcoin. I'm
Yeah.
considering it, but what is it? Like, how does it serve my portfolio? Is it just a leverage play on tech stocks? Is it just high beta Nasdaq? Is it a wealth preservation tool like the Bitcoin maxis would say? Is it the ultimate inflation hedge? What is the purpose here?"
Yeah, I've got someone new coming in asking these questions. You don't want to, inundate them with, too much techno babble and all the fun stuff maybe you or I could get into about blockchain technology. And those are fun conversations. I like to pretty much just, talk about it as digital gold, right? If you're looking for a way to preserve wealth in a digital format, it probably does a really good job of checking off some boxes. I look at it as, a limited supply of something that's scarce. Yeah, speculatory because that's the inning we're in as far as price action is concerned. But that's it. That's, I think, the easiest way to wrap our head around it. So if you're looking for, something that has those characteristics, Bitcoin checks a lot of boxes here. Where people kind of push back is, to your point, calling it high beta Nasdaq, or is it just correlate? Go chart that against the Bitcoin against the Nasdaq, and you're like, wow, it's pretty much going hand in hand here. I get that, but I still also think we're in very much early stage of the game and price exploratory type stuff when it comes to Bitcoin. Don't own this if you're not ready to jump on a roller coaster here. I've been as a OG who's mined Bitcoin back in 2011. I'm not sure how many advisors out there can tell that story, but the drawdowns have been incredible. I think there's at least three 80+% drawdowns I've had to go through, countless 50% or less. The story is any investor who's like, man, I wish I bought Amazon or Apple, 30 years ago, you would have had to survive anywhere from two to three 90+% drawdowns. You probably would have puked on yourself and sold the stock instead of hold the entire time if you're, just a normal investor here. So a lot of lessons have been learned. But yeah, Bitcoin, I think a lot of potential here. You see Wall Street all up in it now with the ETF.
Well, the issue of asset allocation and portfolio allocation is, something that everyone needs to ask themselves. And of course, it varies per person. What are some of the questions I, as an investor, need to ask myself before I decide how much of my portfolio should go into stocks, bonds, crypto, speculative assets, penny stocks if I want to gamble a little bit? How do I make that decision here?
Sure. Financial planning is the best solve all for this. You can obviously take a very extreme view. Hey, what if I put a portion of my wealth or investable assets into something that's truly speculatory? What's the worst that can happen? Yeah, it goes to zero. You can create financial plans around, portions of portfolios pretty much going, to zero. What would it be like if $100,000 of my net worth, got wiped out here? How would that affect my ability to retire, or accomplish a number of goals here? But when we think about, whether it's Bitcoin, digital assets, or, any alternative asset, I like to draw a line in the sand. I don't typically like seeing more than 20% of anyone's investable net worth in any one asset class that's not their personal residence or, like the S&P 500, a main part of their portfolio. And this gets talked about a lot when we have individuals who receive a lot of stock compensation, and if they don't manage that appropriately, end up concentrating a lot of their wealth in their company. We see that. I don't think anyone wants to know if their company has a particularly bad year or quarter. Take like a pharmaceutical company, for example. Got a problem with a drug or a bad debut. You've acquired, $5 million of your net worth, particularly in RSUs and options. You got a 40% correction. That's gonna suck. So, trying to draw lines in the sand and help clients figure out where their specific tolerance for risk is, particular to concentration risk in any one asset, is super important. And I know there's cases you can make. Well, what about your 100% real estate investors who have obviously parked all of their wealth in real estate? I mean, even within real estate, you can think about concentration risk, but there's a general rule of thumb, but it will be tailored to individual investors.
What are the most common mistakes you see people make when they're trying to plan their financial well-being and make a portfolio for themselves?
Most common mistakes, let's see. Again, not providing themselves with enough margin of safety before jumping into investments. I think the whole point of investing
When you say
is,
margin of safety, do you mean cash? Like, what does that mean?
yeah, I mean cash. I mean
Okay.
feeling good that you can sleep well at night and handle
Okay.
life volatility as well as market volatility here. The point of investing is to likely stay invested to reap the rewards of compounding returns. You can't do that if you're reaching into the pot selling assets to go, pay for a broken leg or the fact that you've been laid off.
The
So
the
that
common the common allocation to cash is 5%. Is that too low for most people?
3 to 6 months of living expenses. So if you
Okay.
know, you be intimate with cash flow. That's the rule of thumb. I'm a traumatized, geriatric millennial who started their adult lives in
Yeah.
2008 and only to raise kids during a pandemic. It's like every main point we get to, something crazy happens here. So I'd prefer to see 6 to 9 months of living expenses in cash. It's probably a little heavier than what the textbooks would say, but I have yet to find someone complain that they had a little bit more safety than not before going risk on or going long with their investments. So that's number one, have that margin of safety. Two, classic stuff. Don't try and time the market here. There's simple stuff that you can implement like dollar cost averaging. If you think that the psychology of the situation is you don't want to feel a certain way if you put your money to work and the market corrects the very next day, cool. Average into the market if you think things are going to fall off, but don't replace that with timing the market. Also, you get flexibility there. Say there is a big discount, you're liking in, shorten your window. You get more money in more quickly, buy that dip, so to speak. Again, It's consistency and discipline. Investing is hard enough as it is, whether you're an active investor or a passive investor. Being able to stick to rules and do that and do relatively boring stuff over a very long period of time, that's just not how we're built as human beings. Right? We come from ancestry of don't eat poison mushroom or get eaten by a tiger. We have animal spirits. So doing like, hey, I'm going to put X amount of money into the market every month for the next 10 years, that's not exciting. But I would argue that's generally how you win the game.
Okay, final question. So Douglas, happy birthday. You're entering your 40s. So congratulations on making it to 40.
Did it?
Back in the Renaissance days, that was a feat of on its own. But anyway, we're in the
An
21st century.
old
How is
man.
your how are your budgeting and financial planning priorities going to change, do you think, in the next decade versus your 30s?
Yeah, yeah. So the first I guess my 30s was all about building this business and this wealth management firm and getting it to a point where I felt comfortable in knowing it could continue to grow. For any financial advisor watching this who started their own firm, you all know what the hardest part of this business is. It's getting clients, right? So my wife and I are on to the next phase of the firm. We began with serving millennials and doing something that most wealth management firms wouldn't do, which is cater to us. And now we're older in our 40s here. And now we're going to talk about love and money. I want to make an impact here, not just in the industry, but for individuals to make it pretty clear that if you're in a serious relationship, married or with a partner, this is a game that's played together. I would love to see people communicate effectively and bring fairness into their relationships when it comes to money. I think historically we have personally bad relationships or a bad understanding of money that needs to be improved upon. Can only imagine how much more difficult that becomes when you need to communicate those thoughts and feelings with the person that's most important to you. So we're very excited to get into that area. We're going to have a new book come out next year on that topic and grow the firm in that way. And I think I'm just going to be very cognizant of how I spend my time. I got two young girls who I get to share my time with, and all of that seems pretty fleeting. So I want to pay particular attention to how and who I spend my time with, both in my personal life and in the business as well.
Well, you actually tweeted this because I follow your tweets. I'm going to give you some of the best marriage advice ever. Make sure you and your partner attend any meetings having to do with your money together. It solves so many problems. So I encourage people to check out Douglas's Twitter. Probably the most informative and entertaining Twitter page you can follow in the
Fair enough.
finance world. So do that ASAP. Link down below. Where else can we learn more about you, Douglas?
All roads lead, either from Twitter to Twitter or what we're calling X now, bonefidewealth.com if you want to learn about the firm. Please, if you're interested in the topics of love and money, we have a wonderful newsletter called The Joint Account. You can go to readthejointaccount.com on Substack there and sign up. And every week, try and get you something good in the realm of working with money in your relationship.
Excellent. Thank you very much for joining us today, Doug. We will see you soon. Take care.
Thanks for having me.
Thank you for watching. Don't forget to like and subscribe.